What if the next financial crisis doesn't crash housing prices overnight, doesn't shut down banks with dramatic headlines, and doesn't look anything like 2008 at all? In 2008, the warning signs were subprime mortgages, toxic loans, and over-leveraged banks. Today, those exact problems are not the main threat. Banks are better capitalized, lending standards are tighter. Housing supply is more controlled, yet risk hasn't disappeared, it has shifted. It has evolved, and it's hiding in places most Americans aren't watching. The next financial crisis will not be one dramatic collapse. It will be slower, more complex, and more psychological. It will hit households, investors, retirees, and workers in ways that feel confusing rather than obvious. What makes this moment especially dangerous is that most people are still anchored to old mental models, assuming stability because the system hasn't visibly cracked yet, but financial stress rarely announces itself with sirens anymore. Instead, it leaks into daily life through small compromises, working longer hours for the same lifestyle, relying more on credit for necessities, delaying retirement, postponing home ownership, or quietly accepting lower expectations. And these behavioral shifts are signals, not noise, because when enough households make the same compromises at the same time, the economy slows from the inside out, which then feeds back into corporate earnings, hiring decisions, and ultimately market confidence, creating a self-reinforcing loop that doesn't need a dramatic trigger to become destructive. Consider how many Americans today are technically employed yet financially strained. How many portfolios look healthy on paper but are concentrated in a narrow set of assets that performed well during an era of cheap money? And how many businesses appear profitable only because they refinanced debt during historically abnormal conditions that no longer exist? And now imagine those supports being removed gradually rather than suddenly, forcing adjustments that feel manageable individually but overwhelming collectively, because slow pressure is harder to react to than sudden shock. This is why the next crisis may feel confusing rather than terrifying at first, marked by mixed signals where markets rally one month and fall the next, inflation cools but prices stay high, job numbers look strong while layoffs quietly spread across sectors, and policymakers speak confidently even as their tools become less effective. And in that environment, uncertainty becomes the real cost, because businesses hesitate to invest, consumers hesitate to spend, and investors hesitate to commit capital long-term, which reduces economic momentum without a single catastrophic event. Another overlooked factor is demographic pressure, particularly the aging of the population, which changes how money moves through the system as more people shift from accumulation to preservation, increasing demand for income, producing assets while reducing tolerance for volatility, a combination that can strain markets when returns are lower and risks are higher, especially if expectations were built during an unusually strong decade. At the same time, technological change accelerates disruption in labor markets, creating pockets of growth alongside widespread displacement, which amplifies inequality and political pressure, increasing the likelihood of reactive policy decisions rather than measured ones. And history shows that when financial stress intersects with political incentives, outcomes tend to be volatile, not orderly. What's critical to understand is that none of this requires a collapse of banks, a housing implosion, or a stock market crash to qualify as a financial crisis, because the real damage occurs when trust erodes. Trust that savings will hold value, trust that hard work leads to progress, trust that markets reward patience, and once that trust weakens, people change behavior in ways that slow the economy even further, hoarding cash, avoiding risk, and prioritizing short-term security over long-term growth. This is why preparation today is less about predicting the exact trigger and more about building resilience against prolonged instability. Because resilience gives you optionality, and optionality is the most valuable asset during uncertain periods, whether that means maintaining liquidity, keeping skills adaptable, or structuring finances to withstand income interruptions without panic. It also means questioning assumptions that were once safe, such as the idea that diversification alone guarantees protection, or that long-term averages will always bail out poor timing, because regimes change, and strategies that worked in one environment can underperform badly in another, especially when valuations start high and growth slows. Psychologically, this period will test patience more than courage, rewarding those who can tolerate boredom, modest returns, and uneven progress while avoiding the temptation to chase speculative opportunities promising quick relief from frustration, because desperation is the fuel of financial bubbles, and bubbles don't require optimism as much as they require impatience. As pressure builds, narratives will compete for attention, some claiming everything is fine, others predicting imminent collapse, but the truth will likely sit uncomfortably in between, characterized by grinding adjustment rather than dramatic failure, and navigating that middle ground requires clarity, discipline, and an acceptance that stability does not mean prosperity, just as volatility does not always mean danger. Understanding this distinction allows individuals to make better decisions under stress, focusing less on headlines and more on fundamentals like cash flow durability, debt structure, and time horizon, because when the next crisis finally becomes obvious in hindsight, it won't be remembered for a single day or event, but for a period when many people felt stuck, uncertain, and slowly squeezed, and those who recognized the pattern early didn't escape unscathed, but they avoided the worst outcomes by staying flexible, informed, and emotionally controlled while the system adjusted around them. And that emotional control becomes increasingly rare as financial pressure stretches over months and years rather than days, because humans are wired to respond to immediate threats, not slow-moving ones, which is why prolonged economic stress often leads to poor decisions made out of fatigue rather than fear, such as selling quality assets at the wrong time, locking into bad debt just to maintain lifestyle, or abandoning long-term plans in favor of short-term relief. And this is exactly how wealth quietly transfers from the impatient to the prepared during transitional periods like the one we're entering. Another element that deserves attention is how narratives themselves become financial forces, because markets today are driven not just by earnings and data, but by perception, expectations, and confidence cycles amplified by social media, 24-hour news, and algorithmic trading, meaning sentiment can swing faster than fundamentals, creating whiplash conditions where prices move aggressively without clear justification, rewarding speed and punishing hesitation, which disadvantages everyday investors who don't have the luxury of instant execution or constant monitoring, further widening the gap between institutional players and households. This environment also increases the likelihood of policy overreaction, because public pressure grows louder when discomfort persists, and elected officials are incentivized to act visibly even if the long-term consequences are uncertain, leading to temporary relief measures that may stabilize one area while destabilizing another, such as supporting asset prices at the expense of currency stability, or protecting borrowers while weakening lenders, and these trade-offs accumulate over time, creating a fragile equilibrium that looks stable until it suddenly isn't. Meanwhile, globalization is fragmenting, supply chains are being reshaped for security rather than efficiency, and geopolitical tensions add another layer of cost and uncertainty to the system, which means inflationary pressures may remain embedded even during slow growth, challenging the traditional playbook where economic weakness automatically leads to cheaper living costs and easier monetary policy. And for households, this translates into a world where cutting back doesn't always restore balance, because essentials remain expensive, forcing deeper adjustments that test resilience. The labor market, often viewed as the last line of defense, may also behave differently, with job losses appearing unevenly across sectors and skill levels, making aggregate data misleading, because while headline employment numbers may remain strong, specific industries could experience prolonged downturns, leaving certain workers feeling trapped in shrinking opportunities while others remain insulated, increasing frustration and social tension that feeds back into economic behavior. All of this contributes to a sense of stagnation that is difficult to quantify but easy to feel, where progress slows without fully reversing, creating an atmosphere of constant catch-up rather than advancement. And historically, these periods are when financial mistakes compound quietly, not because people are reckless, but because they are tired of waiting for improvement. It's also worth recognizing how asset inflation over the past decade has distorted expectations, leading many to believe that financial markets should consistently deliver strong returns regardless of underlying conditions. And when that assumption fails, disappointment turns into risk, taking as investors seek to recreate past performance in an environment that no longer supports it, pushing capital into speculative corners that appear attractive precisely because traditional avenues feel unrewarding. This dynamic is dangerous because it concentrates risk at the edges of the system, where regulation is lighter and transparency is lower, increasing the chance that localized problems spread unexpectedly when confidence breaks. Education, therefore, becomes a form of financial defense, not in the sense of predicting outcomes, but in understanding probabilities, trade-offs, and constraints, because the more realistic one's expectations, the less likely they are to be emotionally hijacked by volatility or false certainty. And this is especially important in a time when simplistic narratives are more popular than nuanced analysis. Even though nuance is what actually protects capital, adaptability will matter more than optimization, meaning having room to maneuver financially will outweigh squeezing every possible percentage point of return, because flexibility allows for response, and response allows for survival, whereas rigid strategies break under pressure, and the system ahead will test rigidity relentlessly. Families that treat financial planning as a static checklist may struggle, while those who revisit assumptions, adjust spending patterns, and prioritize resilience over appearance will find themselves better positioned even if outcomes remain imperfect. It's also important to acknowledge that no preparation eliminates risk entirely, and the goal is not immunity but durability, the ability to absorb shocks without cascading failure, whether that shock comes from a job loss, a market drawdown, or a policy shift that changes incentives overnight. In that sense, the next financial crisis is less about a moment and more about a phase, a period of recalibration where excesses are worked off, slowly rather than violently, and while that may sound less dramatic, it can be more exhausting, because it demands sustained discipline rather than one-time courage. Understanding this reframes how success is measured, shifting focus from beating benchmarks or timing markets to maintaining stability, optionality, and mental clarity during prolonged uncertainty, and those qualities, while less glamorous, are what ultimately determine who emerges intact when the adjustment finally runs its course and a new equilibrium begins to form. And as that new equilibrium slowly takes shape, the most overlooked challenge will be resisting the urge to believe that discomfort automatically signals failure, because many people will interpret slower progress as personal mismanagement rather than recognizing it as a systemic shift, which can lead to unnecessary self-blame or worse, reactionary decisions meant to force results in an environment that simply isn't built for speed. And this is where expectations become either an anchor or a liability. During periods of long adjustment, patience becomes a competitive advantage, yet it is one of the hardest traits to maintain when daily life feels more expensive, less predictable, and more demanding than what people were conditioned to expect, especially after years when asset growth masked structural weaknesses and made financial success appear easier and more universal than it truly was. The danger now is that as those tailwinds fade, people may mistake the absence of easy gains for the presence of imminent collapse, oscillating between complacency and panic without settling into the steady middle ground required for sound decision-making. And that psychological volatility can be more damaging than market volatility itself, because it drives inconsistent behavior that erodes long-term outcomes. Another subtle risk lies in overconfidence in institutional protection. The assumption that safeguards built after past crises will automatically prevent future pain, when in reality those safeguards often redirect stress rather than eliminate it, pushing pressure into less visible corners of the system where it can build unnoticed. And when it finally surfaces, it tends to surprise even experts. Not because it was unpredictable, but because it was inconvenient to acknowledge. This is compounded by the fact that modern financial systems are deeply interconnected, meaning localized problems can propagate through unexpected channels, such as pension funds exposed to private credit, municipalities reliant on volatile tax bases, or insurance markets strained by correlated risks. And while none of these alone may trigger alarm, together they form a web of vulnerability that reacts poorly to sustained stress. Individuals navigating this landscape will need to balance awareness with restraint, staying informed enough to adapt but not so reactive that every headline dictates action, which is increasingly difficult in an information environment optimized for urgency rather than accuracy, where extreme views attract attention and moderation feels unsatisfying, even though moderation is often what preserves capital and sanity. Over time, the narrative of crisis may itself become normalized, leading people to disengage emotionally as a coping mechanism, which carries its own risks, because disengagement can slide into neglect, leaving finances unmanaged precisely when active oversight is most valuable. And this is why simple, repeatable systems matter more than complex strategies during uncertain phases, as they reduce cognitive load and create consistency when motivation fluctuates. Another important consideration is that inequality of experience will widen, not just in terms of wealth, but in perceived reality, as different groups encounter very different economic conditions depending on geography, industry, age, and asset exposure, making consensus about what is actually happening harder to achieve. And when collective understanding fractures, coordinated responses become less likely. Increasing reliance on individual resilience rather than systemic solutions, this fragmentation also fuels polarization around economic narratives, with some insisting that conditions are fundamentally strong while others feel left behind and unheard, and both perspectives can be simultaneously true, which complicates policymaking and heightens the risk of blunt interventions that satisfy neither side fully. For households, this reinforces the importance of focusing on controllables rather than outcomes, managing spending habits, debt levels, and risk exposure regardless of broader debates, because while individuals cannot steer the economy, they can influence how exposed they are to its shifts, and small adjustments made early often matter more than dramatic changes made under pressure. The coming years are likely to reward those who can operate without constant validation from markets or peers, who can accept that progress may be uneven and that stability itself is a form of success in a volatile world, even if it lacks the excitement of rapid growth stories that dominated previous cycles. This mindset shift is difficult precisely because it runs counter to cultural narratives that equate success with acceleration and visibility, yet financial durability has always been built quietly, through habits that appear unremarkable until stress reveals their value. It's also critical to recognize that recovery, when it comes, may not feel like relief at first, Because rebuilding confidence takes longer than repairing balance sheets, and even as conditions improve, caution may persist, keeping growth subdued and reinforcing the sense that something is always about to go wrong, a hangover effect common after extended uncertainty. Those who understand this dynamic are less likely to misinterpret caution as permanent decline or temporary rallies as permanent recovery, maintaining a balanced perspective that supports steadier decision-making. Ultimately, the next financial crisis will test not just financial structures, but narratives, beliefs, and endurance, rewarding those who can live with ambiguity without surrendering discipline, who can adjust without overcorrecting, and who recognize that the absence of dramatic collapse does not mean the absence of challenge. Because the most consequential shifts often unfold gradually, reshaping behavior long before they reshape headlines. And navigating that kind of environment successfully requires an acceptance that progress may be slower, outcomes less certain, and signals more mixed than in the past, yet within that complexity lies opportunity for those prepared to operate with clarity rather than urgency, flexibility rather than rigidity, and patience rather than prediction, understanding that while no one can control how the system evolves, individuals can still choose how resilient, adaptable, and grounded they remain. As it does here, is a powerful, emotionally resonant conclusion that ties together the entire speech and leaves a strong final message for US YouTube audiences. The most important takeaway from everything we've discussed is this: the next financial crisis will not arrive with a single breaking news headline or a sudden collapse that forces everyone to pay attention at once. It will unfold quietly, through pressure rather than panic, through adjustment rather than disaster, and through endurance rather than shock, which is exactly why it will catch so many people off guard. Not because the warning signs weren't there, but because they didn't look dramatic enough to demand action. History shows that the greatest financial damage is rarely caused by one bad day, but by a long series of small decisions made under stress, uncertainty, and fatigue. And the people who come through periods like this intact are not the ones who predict perfectly or react the fastest, but the ones who prepare early, manage risk realistically, and stay emotionally disciplined when the environment stops rewarding impatience. This is not a call to fear the future, but a call to respect it, to understand that resilience is the new advantage, flexibility is the new growth, and clarity is the new wealth. Because when systems recalibrate and expectations reset, those who focused on cash flow adaptability and long-term thinking will find that they didn't just survive the transition, they positioned themselves for what comes next. And that is why awareness matters now, not when the crisis becomes obvious in hindsight. Because the decisions you make before pressure peaks determine how much control you have when it does. So stay informed, stay grounded, and stay intentional with your money. And if this perspective helped you see the future more clearly, subscribe to the channel for deeper, honest conversations about money and markets. Share this video with someone who needs to hear it. And leave a comment below with your thoughts on what you believe the next financial crisis will look like. Because understanding what's coming is not about predicting the exact moment it arrives. It's about making sure you're ready when it does.